Ever wondered how to spot a good real estate investment, especially in a unique market like China? Today, we're diving deep into Sasseur Real Estate Investment Trust, or Sasseur REIT, the first outlet REIT listed in Asia. We'll break down its recent performance, what makes it tick, what could trip it up, and whether it's a good consideration for your portfolio right now. Stick around because by the end of this video, you'll have a clear picture of this fascinating REIT. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. What Sasseur REIT actually does. Unlike traditional malls that charge fixed rent, Sasseur REIT operates a portfolio of premium outlet malls in China using a unique and trusted management agreement. Imagine this. The REIT gets a fixed rental component that grows by 3% annually, providing a stable base. But the exciting part is the variable component, which is tied directly to the actual sales performance of its tenants. This means if the shops do well, Sasseur REIT does even better. Over 90% of their income is linked to these sales, aligning their success with their tenants. They currently own and manage 4 high-quality outlet malls in some of China's fast-growing cities: Chongqing Langdang, Chongqing Bishan, Hefei, and Kunming. Chongqing Langdang is often highlighted as their star performer. So, how has Sasseur REIT been performing? Let's look at the key numbers, especially for the latest financial year 2024. Their occupancy rates are incredibly strong, hitting a record high of 98.9% in Q4 2024, showcasing the demand for their spaces. In terms of rental income, while the renminbi figures show a slight increase when converted to Singapore dollars, their EMA rental income saw a marginal decrease of 0.4% in FY 2024, largely due to the depreciation of the Chinese renminbi against the Singapore dollar. This currency fluctuation is a recurring theme you'll want to remember. Distribution per unit, which is what shareholders receive, was 6.082 Singapore cents for FY 2024. This was a 2.7% decrease from the previous year, again, partly impacted by that strong SGD and higher finance costs. If we look back, their DPU has seen some fluctuations with a record high of 7.104 cents in FY 2021. Now, for their financial health, Sasseur REIT boasts an incredibly robust balance sheet. Their gearing ratio, or aggregate leverage, is a historical low of just 24.8% as of December 2024. This is one of the lowest among all Singapore REITs, giving them massive headroom for future growth, about 895 million Singapore dollars to be precise. Their interest coverage ratio is also very healthy at 4.6 times, meaning they can comfortably cover their interest payments. Plus, 87% of their borrowings are hedged to fixed rates, protecting them from rising interest costs. They even managed to secure new loans from their sponsor with no refinancing needs until 2026. This strong financial position is a major draw for investors. What's driving Sasseur REIT's future growth? Several factors play a crucial role. China's outlet boom. The outlet industry is the fastest growing retail segment in China, benefiting from a consumption downgrade trend where consumers are looking for value for money branded goods. Proactive asset management. They're constantly optimizing their tenant mix, strengthening brand partnerships, growing their VIP customer base, which contributes over 60% of sales, and investing in asset enhancement initiatives like upgrades to their Huff A Mall and new parking facilities. Acquisition-led growth. Sasseur REIT. has a right of first refusal to acquire 2 more outlet malls from its sponsor located in Lebanon and Guam. These could be DPU accretive, meaning they add to experiential retail. They're transforming their malls into lifestyle destinations, offering more than just shopping. Think entertainment, dining, and unique events to attract more footfall. Strong sponsor support. The Sasseur Group, their sponsor, provides significant operational expertise and financial backing, including unsecured loans. No investment is without risks, and Sasseur REIT is no exception. Here are the main challenges. Currency fluctuations. This is perhaps the biggest and most consistent risk. If the Chinese renminbi continues to depreciate against the Singapore dollar, it directly reduces the DPU when converted back to SGD, even if the underlying RMB performance is stable or growing. China economic slowdown. While the outlet sector is relatively resilient, a prolonged economic slowdown in China, rising unemployment, or decreased consumer confidence could impact discretionary spending and thus the variable rental income. EMA model dependence. While generally stable, if the sponsor faced significant challenges, their ability to support the fixed income component of the EMA could be tested, though their current financial health suggests this is a low risk. Concentration risk. The entire portfolio is in China, making it susceptible to country-specific economic, regulatory, and geopolitical risks. Competition. The retail landscape in China is competitive, and they need to continually innovate to maintain their market position. So, what are analysts saying, and is Sasseur REIT attracting investors right now? Analysts generally have a strong buy consensus for Sasseur REIT, with an average target price suggesting a significant upside potential. They are positive on its defensive nature, high dividend yield, and exceptionally low gearing. Why is it attracting investors now? Attractive dividend yield with a trailing yield currently around 9.5% to 9.65%. It offers a significantly higher payout compared to many other REITs and investment options, making it appealing for income-focused investors. Resilient business model. The EMA model, with its fixed and variable components, provides a degree of income stability even amidst economic fluctuations. Strong financial position. The low gearing and ample debt headroom are major positives, offering flexibility for growth and a buffer against economic shocks. Growth prospects. The expanding China outlet market, coupled with Sasseur REIT's proactive strategies and acquisition pipeline, offers promising long-term growth potential. However, should you consider it or hold for now? While the high yield and strong financials are compelling, the persistent renminbi depreciation remains a key headwind for SGD DPU. Investors need to be comfortable with this currency exposure. Also, while outlets are resilient, the broader Chinese economic uncertainties cannot be ignored. For investors seeking high, stable income with exposure to the growing Chinese consumer market and comfortable with currency risk, Sasseur REIT presents a compelling option. However, if currency stability is paramount, or if you have concerns about the Chinese economy, a hold or a more cautious approach might be warranted until more clarity emerges. In summary, Sasseur REIT offers a unique exposure to China's thriving outlet retail sector, backed by a resilient EMA model and an exceptionally strong balance sheet. While currency headwinds and China's economic outlook present challenges, its high dividend yield, low gearing, and growth strategies make it an attractive consideration for income-focused investors looking for opportunities in Asia. Remember, this video is for informational purposes only and not financial advice. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. If you found this analysis helpful, please hit that like button, subscribe for more in-depth market insights, and let us know in the comments below what other REITs or stocks you'd like us to cover. Thanks for watching, and we'll see you in the next one.